So, ladies and gentlemen, there we go. Let's try that again. Ladies and gentlemen, big warm welcome. My name is Adam Harris, and I will be your speaker today. This is part of the Strategy and Focus webinar series, and the topic today is which assets should you eye in August. So, it does appear as though I am streaming perfectly fine, and GoToWebinar seems happy. You should be able to hear me as well. If you have any questions, for those of you on GoToWebinar, if you have any questions, please feel free to type them into the questions box. And I have the questions box brought up on my side here, so I should be able to see if you do, and then I can respond. All right, so you should be able to hear me and obviously be able to see me. And again, for those of you who are watching via streaming, you should also be able to hear and see me. I don't know why I'm stuttering. This is a brand new thing, not stuttered before. So I'm speaking to you while I give you a moment to digest the disclaimer, which is standard. I will give you some background behind who I am. So my name is Adam Harris. I'm a regulated trader based in the UK. I live in Herne Bay, which is about an hour from London. I'm on the coast, just across the way from France, near the cliffs of Dover. And so I manage client funds as well as my own. I'm a trader as well as an investor. What is the common connection there is that I am a technical trader. All right, so because it's technical, everything I do is on a technical backbone. That means that I can determine stocks or trades like commodities or currencies based off technical signals. So I'm very excited today to be able to take you through that. If you have any questions, as I said, I would love for that I'd love for it to be as interactive as possible. Okay, so don't be shy. So on the agenda today, we're going to talk about how to analyze assets on short and medium term charts to determine the best trading timeframes. We are going to look at key support and resistance levels that could determine Bitcoin's next move. So we'll have a look at cryptos or Bitcoin, potential reversal candidates across bonds or commodities or currencies. And quickly on that note, so what we refer to, so when we talk about cryptos or we talk about currencies or we talk about bonds or equities, for example, those are different asset classes. All right, and from a technical perspective, they are almost all identical. I would say that equities and indices, global indices, have some unique characteristics compared to, say, currencies, but they tend to produce very similar patterns. So technical traders can trade any of them, but I'll kind of highlight the differences as we go through them. So as a technical trader, you can choose to trade just currencies if you want to. You only need 3 or 4 charts at a time. If you're looking to invest in stocks or trade stocks, you might want to look at a few more, so you've got choice there. You might want to focus on cryptos for whatever reason, if you like the volatility there. So when we say volatility, we mean movement, all right? Movement in those markets. And so when we say volatility, there's a lot of volatility in cryptos. There's often quite a bit of movement in them. We're going to talk then about risk management strategies that can be employed by day and swing traders. What's the difference between the two? Funny enough, day traders trade during the day and on timeframes below the daily. This is a general loose explanation, and swing traders tend to trade above the daily. Okay, it's counterintuitive, but there's a few language word issues that we use that can be counterintuitive, such as a buy stop or a sell stop, which is actually an entry into a trade, versus a stop loss, which is an exit out of a trade, or a profit target or a take profit, for example. And then we can talk about the effect of news and economic data. I think very quickly we can highlight this and say, look, when we talk about the effects of news and economic data, for the most part, they introduce volatility into the markets, which can be the same as throwing a rock into the ocean. There's already waves and movements happening in the ocean, but it can create a splash and create some ripples, and then eventually it will just fade away. So news and economic data creates a temporary amount of volatility in the markets. It tends to impact traders who are trading below the daily time frame, below the 4 hourly. So 5 minutes, 30 minutes, 1 hour, and maybe the 4 hour, for example. All right, tends to be able to create volatility there. Very few professional, consistent traders trade the news. It is not a reliable way to trade the markets. It introduces randomness, and so it produces higher risk, lower probability trading opportunities. We usually want, for most people, although there are different styles, generally, most people prefer to have a higher win ratio, which means that they win 70%, 60 to 75% of their trades that they make money on. Whether the profit ratio is 1R or 2R, 3R, meaning the risk to reward, depending on what that is. Okay, very few people, if any, want to have 9 losing trades out of 10. Okay, so most people will sit the other way around. They would rather have 6 or 7 winning trades out of 10 and then earn some profit off those. Okay, so that being said, effective news and economic data will impact day traders, those who trade below the daily time frame, much more than those who trade above it. If the market is on edge, so we're in a bear market, or maybe we're in a bubble and it's about to burst, then we might find that the markets are more sensitive to certain things, such as interest rate hikes or jobs numbers, for example. Okay, but pretty much the rest of the time, they're not. Okay, so let's clarify a few things here. I'm going to screen grab this because I want it up on the right-hand side while I talk to you about certain things. I'm just going to grab this agenda and keep it over on the right-hand side over here, and then I can refer back to it to make sure that we go through these different things. Okay, so we'll go across to the charts and we'll come back to this. So there's a couple of things that I want to do. The very first thing I want to do is to confirm for you that we are in a bull market. Okay, that we're in a bull market. So I've got different tabs here with different types of layouts, but it's mostly pretty straightforward. I use a simple 15 period moving average in red, or a 20 in blue, or a 10 in black. They can be simple or exponential. The differences between the two, I want to say it's negligible. I don't want to offend people, but it's similar enough that I don't have to be too concerned about the differences between them. I'm happy to use either. Doesn't really change the result. a trend, an uptrend is made up of a series of higher lows and higher highs, a collection of them. So in other words, a trend is not a single move, a trend is a series of moves. Okay, it's a collection of moves like waves. A downtrend is made up of lower highs and lower lows. It's a collection. That's really the important part that you need to understand here. A trend is when there's a repeated movement, and because the trend is in place, that tells us that there's intent behind the move. All right, no trend, which is as important to be able to identify. No trend is when the lows and highs are mixed. We get randomness. Now, when we see these types of risk to reward, let me just go through and fix this. Not sure why. Okay, I've got a very strong internet connection. I shouldn't be experiencing any issues here. One thing I do want to have a look at here, bear with me please, is preferences, settings, streaming, video, output. Okay, I'm just going to try something here. Okay, let's see if this changes things. So come on. There we go. All right. So when we look at a chart, we want to be able to determine if there's a trend in place. So the way we do this is we look at the last kind of series of lows and highs, and we look to see if the market is going up, going down, or not really going anywhere. So right now we can see in general that gold is going up, and what we should do is trade in that direction. So that is the first rule. Once we know what we should be doing, we should be trading in that direction. The next question, so now we've determined, yes, there's a trend, the trend is up, then it becomes about timing. Timing is tricky for newer traders and newer investors. It's the part that they complain about the most, that they struggle and battle with the most. It's absolutely natural and normal to struggle with that. Timing becomes an issue. Basically, what we're looking for to keep the concept simple, so the idea is simple, the action is tricky, is we're looking for a pullback or a breakout. So when price is in an extension mode, it pulls back. Extension, retracement, extension, retracement. We are looking for this period here where the market is in a pullback mode, and that is counterintuitive because the price is coming down in an uptrend, which feels counter to what we need. But every single entry into a market comes from one of only two locations. That's it. It is either on a break, so in other words, as it goes to a new high, on a break to a new high, on a break to a new high, or it's on a pullback. So here's the pullback, and then it breaks out. Here's a little bit of a pullback, breaks out. Here's a consolidation, which is also basically a pullback and a breakout. Okay, here it's on a pullback, and there's a breakout. Okay, here's a pullback, and there's a breakout. So it's either on the pullback or on the breakout. So as price pulls back, you're either getting in here, or the very last place you can get in is here as price goes on. Most people will try to get in on the pullback, because it's more efficient, more economically efficient. Okay. It's more economic. Okay. From a money perspective, I mean, it's from a risk perspective, it makes sense. So next up, once we know location, we're looking for a break. And there's a beautiful little trick we can use to help us determine that. There's a couple of different things. First of all, often we might go back to a key level. So we might pull back to a key level, find an entry there. That's one way. We might find that we pull back, for example, to a trend line. back to a trend line. This is pulled back to a trend line and pulls back to a key level. So there's a couple. The beauty of trading, lots of things overlap. Different strategies, although they might seem different. The 9 and 21 moving average crossover and the 10 and 20 that I have here, they're actually so close to each other that pretty much produce the same types of trading signals. Fibonacci levels, pivot levels often overlap. So pivot levels, Fibonacci levels, and horizontal levels often overlap. So they produce similar entry signals in the same locations. So as the longer you trade, the more everything just merges together until you kind of just simplify things. You can take things away because I don't use pivot levels or pivot levels because I use horizontal levels, and the pivot levels and pivot levels often overlap with those. Okay, so one cool little trick that I can use to help me identify areas is to add in moving averages. I'm going to go back to the template where I had moving averages in place. I'm not going to use that one. I want to use the old one. Here we go. So here I've got in the 50, 20, and 10. And I want you to just observe that when the market is trending, often price will pull back to the 10 and 20 together as an air. Price will match it and then take off. Okay, so it'll hit away, come back, hit away, come back, hit away. Same thing, hit away, back, hit away, come back. In the downtrend, hit it away, came back, hit it away, came back, hit it away. And so it often pulls into the 10 and 20 averages. And therefore, the 10 and 20 averages can provide me with a location where I can join a trend. It's very good at that. So for newer traders, what I don't want to be doing is I don't because I want you to see this. I don't really want to be joining price or try to chase a trade when it is less the moving averages. If it's less, think of this as a transition. So when price falls into the transition, my entry should always be from somewhere within the moving averages as a location. If price has already left the train station and I'm chasing it, and the risk of losing trade increases. Okay, so we've broadly discussed identifying a trend, and then broadly as well discussed where we would find an entry from within the moving averages. In addition to that, we look for a few other things. So let's recap where we are. First of all, we determine the trend. Then we look for timing, which is when it's in the moving averages. So where to get in, which would be located in moving averages. What should we look for? What should we look for in terms of candlesticks? What are we looking for signals? So let's go to the market. Let's look. So we see price falls back into the trading station, and we get a beautiful green candle. It's beautiful. I love that because it tells me what? It tells me the buyers are returning back into the market to do another leg. Even here, there's a very quick pull close to the images. There's a nice bullish candle. Here, there is a pullback. It does take off, and then a pullback again. So this would be a decent trade. Not every trade can be a winning trade. You're looking for 6 to 7 out of every 10 trades. Here's a nice little breakout. It's a beautiful breakout. Even so, it pulls back into the moving averages and then takes. Okay. So the moving averages for the nice little bullish candle, nice little green candle, can be a really great entry in the markets, and I would usually need to put my entry above the high of that, stop loss below that. 1 or 2 points above the high, 1 or 2 points above the trending, the below that, so I get that. So for example, here we have a really nice bullish candle pullback, and looking for the markets to go higher. Another little golden nugget that I'm going to give you here is that the quality of the trend is really important. You can see that it's smooth and calm and rational. That's beautiful. That tells me the trend is strong and healthy. So just in case you're sitting there thinking, well, what if it's gonna? It can look like that, and then we could have a bear market. You know, the market crash can happen. Now, first, a one-day market crash pretty much where you can really predict that. And they're not necessarily in the world. As you can see, we had one recently. The market recovered relatively quickly. A bear market takes between 3 and 18 months to occur. It takes a long time because the weekly chart has to go from an uptrend. Every candle is a week's worth of behavior into a downtrend. So that period where it goes from a bull market up here to sideways to a bear market takes anywhere from 3 to 18 months to occur. It takes a long time. Okay, so the next thing I want you to pay attention to is how nice and calm the market is when it's happy. It's a nice, smooth flowing, very orderly behavior. We call this optimal price action behavior. That's when it's in a bear market, which is this period over here. In a bear market, which is this period over here, the market is very choppy. The behavior has become more erratic over here, up and down and up and down and up and down. Why is that? Well, because there's lots of buyers still in the market, and there's lots of bears and sellers getting in. So some people are panicking, getting out. Some people are trying to sell, get in, and some people are trying to buy because in the long run they expect the market to go higher. So this was our bear market. So I quickly want to explain to you why this is to do with today's topic. How do you might be saying, well, are we in a bull market or bear market, or what if we have a bear market tomorrow? We are in a bull market. So there's a couple of things that you need to know. I'll take you through them. Reasons why we are likely not at the start or anywhere near a bear market or a recession. Number one, bear markets occur less and less over time. If you go back 100 years, if you go back to 1924, bear markets were occurring every 1 to 3 years. Every 1 to 3 years. So they were happening a lot more frequently. Since 1990, bear markets have occurred anywhere from every 7 to every 12, 13 years. So they occur less and less often. Two, we've had both COVID, the market crash, and we've had a legit bear market. Let me show you. So, and I'll highlight it using these lines. So this was COVID. There was COVID, and then we had stimulus, and the market recovered. Okay, stimulus cash. So why would the market recover very quickly? One of the things I want you to know, stimulus cash, often stimulus money is borrowed by companies. Those companies might be cash rich already and making plenty of profit already, but they can borrow that money, huge amounts of money at zero interest, and often those loans can be forgiven. So they borrow the stimulus cash and they throw it into the stock market. So I want you to understand why the stock market often recovers really quickly as soon as there's any kind of stimulus cash available. They borrow, they put it into the market, everybody's doing it, and the market gets boosted. And so the stimulus cash works because the companies can say that, well, they need the money because they've got to keep themselves afloat and you don't want people to lose their jobs. Stimulus cash works really well for that. All right. So that was our very first correction that we've had. I'm going to show you a little bit more in a moment. And this was our official bear market. So to make it clear, this is where we go into a downtrend on the weekly. And this was the first real bear market that we've had since 2007. So this area over here is the global, let's not do this way, I'll do it this way. This over here is the global financial crisis, 2007, 2009 global financial crisis. That was our really last major global bear market. That's it. Since then, 2009, under Obama and Biden, interestingly enough, under Obama and Biden to about here. All of this is Biden and Obama. Very nice and calm, orderly, market recovers, beautiful bull market. Okay, so I'm going to clear that up. Let's go in, let's zoom in a little. So I want you to get a sense of how long the last bull market was. Okay, from around about end of 2009, 2010, we started the new bull run. We started the new bull run. Went all the way up to January 2017, which is about here. Call it here. This is where Trump took over. About there. So this, believe it or not, is actually the tail end of the Obama-Biden policies. That continuation is inherited from this previous very calm, rational thing. This period here is what's known as an election year. This is when there's a lot of uncertainty, so the market decided to go sideways for a bit. No bear market, no correction, just went sideways for a bit. Then we had a continuation when the new administration came in. And this is, let's just do this, up until here from January 2020. Okay, so from about here, This period is Trump. Okay, so this period is Donald Trump. And there's a lot of quite a bit of chaos. Obviously, also we've got COVID coming in as well. But I want you to just observe the chaotic in the market. The reason for this was things like tariffs, assassinating. There was a political, I forget, Iranian president. I might have the country wrong. Khashoggi. Anyway, there was a whole thing. I've got to forget what that was, but there was some crazy stuff that kind of happened. The market was a lot more volatile, and then it finished off with COVID, which is up here as well. So I think it's important to kind of be able to identify a lot of that kind of market volatility, which then finished with COVID. Okay, now this is unique because the US had 4% of the world's population, 4% of the world's population, and 25% of the world's cases, which is really because it was just grossly mismanaged and there was no support. They didn't take action. They pretended it wasn't a real problem. Then they didn't want to take vaccines. And it was just a political nightmare. And then, just a lot of people died. Nearly 1 million people died that didn't actually have to die. So it was just chaos. Then we can kind of see how as soon as it kind of calmed down, people started taking the vaccine, all the kind of things, plus the stimulus cash, everything started to kind of recover, started to pick up from there. So I wanted to show you this. So the reason I want you to see this is that this constitutes a very big market correction, really big market correction, and then a bear market. So when you zoom out and you look at all of it, we've had a bear market and another, I'm going to call it kind of a bear market, a market correction from 2009, which means we had a really nice bull market, let's say up until just COVID, call it up until COVID was a really kind of sort of bull market. But every time the market is correcting, it's giving off pressure because obviously it's been running and running and running and it needs to take a break. So every kind of a correction actually helps. So in a way, the COVID correction was a really good way of cooling the markets down and giving it a chance to correct. Then it had another run and then it had a bear market. My point is this, we've just come out of a bear market. We've just come out of a bear market, and one of the tools that we can use to determine this is on the weekly time frame. I want you to have the confidence. I want you to know we're in a bull market, and I want you to know that we've just come out of a whole lot of bear markets, and therefore we're kind of due for a really good run. I'm not saying we won't have corrections, a couple of, we'll have a few months every year that we'll probably have a bit of a correction, but overall we should continue to climb for the next 7 years at least. So we should have plenty of time. It keeps everyone nice and calm, and it keeps you trading. You don't want to be selling in these markets. Even in the bear market, if you sold, you lost money because it drops and then climbs, drops and climbs. And so a lot of people sell as soon as it gets to a new low, and then the market comes back up and then it turns around. And usually a bear market lasts anywhere from 8 months to 18 months. They don't last very long. So it's better to just stay out of the bear market and wait for it to go back into a bull market and then just buy like crazy. Or if you're investing, to look at buying opportunities as it starts to come down to this correction. And if you look from the last low to this high, this pullback was a 50% pullback. All right, 50% for pullback. %50 pullback to the letter and went off. By meaning, I'm saying that that's good because the market had a really decent correction, which it needs. Okay. So the trick to this, believe it or not, is the 50-period moving average. So we're going to use the red 50-period moving average, and this is the guide that tells us we're in a bull market or bear market. Generally speaking, if you're above the red 50-period moving average, you're generally bullish. If you're below it, you're generally bearish. Generally bullish, generally bearish. We're above it right now. We're generally bullish, but not just that. We are producing higher lows and higher highs. So we have an uptrend and we're above the 50-period moving average. You can see the point here at which we go into a bit of a downtrend. We drop below that. We stay below this until here we start to shift into an uptrend and we're back above that. So the weekly, generally speaking, if you have a downtrend and you're below the 50 on the weekly, you're generally in a bear market. Okay, when you're above it and you have an uptrend, you're generally in a bull market. Cool. So that helps you determine we're in a bull market. It also tells you that when we come close to the 50-period moving average, that can be a really good buying opportunity. Now that we know that, let me go back to my checklist over here. So what have we covered so far? We're talking about how to analyze assets on short and medium term charts to determine the best trading timeframes. I'll cover that in a moment. Key support resistance levels that could determine Bitcoin's next move. I'm going to do that now. Potential reversal candidates, bonds, commodities, currencies, risk management strategies. So first of all, what we've actually really covered today is news and economic data, how to determine a trend, how to determine we're in a bull market, and a trading strategy. That we've covered all of that so far. So now what we're going to do is go through all the different charts and do that. Now, everything that I've spoken to you, the strategy as well, can be applied across all the different time frames. So for example, let's just change this up. Let's bring back the template. Okay, and let's go and have a look on a lower time frame. So on a lower time frame down to even 1 hour, we could see a similar type of behavior. The train pulls into the train station, leaves. As it pulls into the train station, leaves, pulls into the train station and leaves. It's in or around the 10 and 20 moving averages. So that strategy can work on multiple time frames. If we go ahead and have a look at a different market, so let's go ahead and have a look, for example, at maybe dollar yen. Let's go down to maybe a 15-minute time frame. As a delivery. You can see the same thing here. Price is a lot more volatile. So this is an example of increased volatility, but you can see how the market is pulling back and taking away, pulling back and taking away. And you can see if we go down to here, we go down to a downtrend, we have the same thing. Excuse me for a second. Hi. Here we go. Thank you. Yep. Thank you. Cheers. Sorry about that. Just had to, before the dogs kick off. Okay, so you can see that this works in a downtrend as well. And usually what we want to be doing, ladies and gentlemen, is looking for an entry. As I said, in this case, a nice bearish candle. So the sellers are returning here. Bearish candle, stop loss above the high, and targeting 3 to 1. Ideally targeting 3 to 1. That's a bad way of showing it, but ideally targeting 3 to 1 as often as possible. And the beauty of this is that the candle size can somewhat determine how things go. Okay, so here's a very nice rejection candle. It is green, but it's a very nice rejection candle. It's probably also occurring off a nice level of support and resistance, and we could target 3 to 1 on that as well. Okay, so various ways in which we can do that. So now what I want to do is I wanted to show you first of all how time frames for day traders, for example, this is a 5-minute time frame. But depending on what, whether we're a day trader or not, we could be looking for opportunities here. So for example, let's go look at not dollar CAD. I want to have a look at some of the others. I want to have a look at things like Euro CAD, which was quite bullish yesterday. Okay, so if you go look at it on a daily, for example, you can see that it is trending higher. I'm going to look at pound CAD as well. Wait for that. Pound CAD trending higher. What else have we got that looks really good? I quite like some of these pairs against US dollar CAD. So this is a little bit overextended, very volatile and choppy. I want something that's a less volatile. Let's have a look at gold, for example. Let's go back to gold. Gold's looking nice and bullish, but you can also see, for example, that it has broken through this level of resistance. There's a nice level of resistance, multiple touches there. You need a minimum of 2 touches at a level to determine that it is a key level. A single touch doesn't mean anything. Minimum 2 touches. Here we can see we've broken through this level. Price is starting to stall a little bit. It's possible that the market is preparing to come back down to test this level and then continue up. Okay, that's a possibility here. It's starting to slow down a little bit. And this is on the daily time frame. So how would a day trader, swing trader deal with this? The swing trader would more than likely wait for the next few days, maybe even next week, wait for price to come back into this area, and then look for a bullish candle in the moving averages, off a level of support, maybe off a trend line, and then look for that reason to take the trade, entry above the high, stop loss below the low, targeting 3 to 1. Okay, can gold keep going up? Not necessarily. If you're wondering if that's the case, that's a really good point. Historically, I know this is going to sound odd, but I was around. I probably started my trading journey as a trader probably somewhere around here-ish, probably here. And gold had never really gone up to these highs, and it went up, couldn't really get past this level over here. And everybody was absolutely convinced that it was going to just keep going. And this is gold. This is our oldest, most widely used currency commodity. And it just continued around, and for several months, so actually topping out in September 2011, and then ultimately breaking to a low in 2013. Look at that, in April 2013. So for a very long time, it went sideways, and then it broke. And once it broke, it headed down and started to break below these levels. And it went below 1300. I'm rounding it out. Went below 1300 and didn't come out until 2019, which is this period over here. So it's had a long consolidation, and it's basically then managed to break out. It's then had another consolidation and has managed to break out and is going up, right? But could it come down? Could it top out and then come back down and, you know, go underground for 5 or 6 or 7 years? That's always a possibility. It's really important that you learn this lesson now, that any market can collapse and can stay where it is. It can happen. You need to have that idea in your mind so that if it does start to happen, you can accept that it's happening. Because a lot of people, for example, when they got caught in the Bitcoin bubble, they couldn't accept that the bubble was bursting. And that's where they get caught. You need to understand that if it can happen to gold, it can happen to anything. And the clues, again, would be at, you know, breaking of those key levels. Now, right now, my question is, what's the trend for gold that's up? Would I say that it's overextended? Does this behavior here look similar maybe to this period here or this period here? Yeah, I do think we're maybe due for a bit of a correction. How far back could we correct? We could come back as far as this. We could come back down to that 2000 level. We don't have to, but we could. But we are due for a bit of a correction. And so I'm a little bit cautious on that. I just want to kind of get that idea in your minds that it looks really good on the weekly. Incidentally, it's had a really nice consolidation over here. It's had a beautiful consolidation here and just broken out. So it doesn't look that bad. But I just want to prepare you that at some point the monthly also has to have a retracement. Okay, so let's have a look at Bitcoin. Let's go through and have a look at Bitcoin and bring that up. We're going to apply the same principles. Am I missing something here? Just bear with me while I quickly also go check my symbols. There's indices. I don't have that. Why don't I have Bitcoin? Okay, I apologize, guys. I do not have access to Bitcoin here. So I'm gonna have to leave that. But I would say this, I've looked at it already, and its structure is very similar to a lot of tech stocks. So if I bring up, maybe not Apple, but if I bring up, and let's clear these objects, but if we have a look at some of them, it has a very similar structure to tech stocks. And it is in a way a tech stock, all right? It's a digital currency, it's technology based, it's a digital commodity. That's really what they are, but it's also tech priced. And also a lot of that money going in is money coming from big institutions, JP Morgan, Morgan Stanley, and a couple of the other places as well put money in. And they put that money in where they also put it into other portfolios. So that behavior is very similar to some of the tech stocks. And so the short answer is, what do I expect of Bitcoin? I expect it largely to be highly correlated with tech stocks. So if tech stocks are booming, for the most part, cryptos will be booming. If tech stocks take a bit of a hit, largely cryptos would also take a hit. It's very rare. I've only seen once where tech stocks took a hit during the bear market and cryptos kind of held their place. They did okay. It's very rare. Otherwise, they're pretty much joined at the hips. Okay. Key support resistance levels that we need to have a look at, that's fine. Potential reversal candidates, bonds, commodities, currencies, and risk management strategies. So risk management strategies, generally speaking, is you would look to have your stop loss placed below a key level. So if there's a trend going up, you would like to put your stop loss in that level. Could you put your stop loss below this big candle? Yes. Could you put it here? Yes, you could. Could you put it here? Yes, you could. But the further away you place it, the further away your profit target is. So there is a sweet spot, which is generally below the most recent swing low, or in a downtrend, it would be above the most recent swing high. But sometimes you could put it in a second place. So in other words, I could put it here or put it here, and both of those would be acceptable, but there are consequences to the fact that I've moved it further away. But putting it behind the third one is maybe a little bit too far. And taking profit is really important, guys. The market can go up for several months and then go down for several months. The purpose of trading is to capture the move, the immediate move. So if there's a trend pulling up and there's a trend, the purpose of a trade is to capture this move. The purpose of an investment is to ride all of that out. That's the difference. So traders are looking to capture impulses, which is a single move as often as possible, and investors are looking to just ride the general wave. So investing is a slower, longer, more patient period. Trading is a shorter term, more active period, even if it's on the weekly. Even if it's on the weekly, you're looking to catch that impulse. Okay, so that really talks about the risk management and how many positions. If you're an investor, you might have, if you're an investor, you might have up to 20 positions in the markets, 20 stocks. I've got 55, 60 constituents. I'm more influenced by Peter Lynch as an investor, and Peter Lynch could have up to 1,000 stocks in his portfolio because he would just like to look at lots of different things. He just was a fan of different things. Warren Buffett would have something like maybe 12 different positions in the market. And so, but he knows, and that's his proprietary knowledge, him and Charlie Munger, they'll have a specific position. John T. Bogle might have 20 or 30 positions. So actually, excluding Warren Buffett, most traders will look to have more positions, not less. All right, more positions is actually safer. Having 20, having my budget spread over 20 stocks, as long as they're not all the same, is actually smarter than just picking one or two. I'm not putting all my eggs in one basket. I can diversify. Diversification might be lots of different companies within tech stocks or the tech industry or tech sector, but it might also be different sectors. So it really depends on your approach there. But risk management includes not just how much I risk per position, whether it's 1% or 2%, and obviously targeting 3 to 1. So I'm expecting my average trade at least to make 2 to 1, at least. Some might make 4 to 1, but ideally we're looking at, I'm aiming for 3 to 1 on average. Sometimes I get 2 to 1 out. Okay, and it's always a good idea to take some partial profits. All right, so let's have a quick look at, for example, the bond markets as well. Let's see what we've got here, because bonds are looking really interesting to me. So we're going to look at the US 10-year. We're going to look at the Eurobonds and the bubble, for example, as an example. So let's look at the US one. Okay, we don't have a lot of history here. It's a weekly chart, but it is trending higher, and we've also started to break above these previous highs. We've had a nice little pullback. We're looking good. Remember the weekly 50-period moving average. We are above it. We are producing higher lows, higher highs. We've actually got the 50, the 20, and the 10 in the correct order. So we're bullish on bonds. That is good. And the bond markets can often over time go up. So the US 10-year for me is looking good, and it can produce some incredibly smooth trends, really good. So for traders who only focus on currencies, I implore you to consider looking at stocks and bonds to see how nice and smooth their trends are. And often they really only have one direction. They will generally go up, generally. Okay, that's a general rule of thumb, but they can often be really smooth and well-behaved and head up. So bonds could be something that's really worth looking at. At the end of the day, ladies and gentlemen, it actually doesn't matter where you make your money if you're doing trading. If you just decide, I'm just going to trade the US 10-year T-note, that's all I'm going to trade. I'm not going to trade anything else. But you know what? I have like a 90% win rate. Then that's your personal golden goose. Then you milk it for as much as possible. I can jump between various markets because my ability to scan the markets has improved, and I can find lots of opportunities. So for me to run through all of the charts that you see here, which is all the commodities, bonds, indices, and highly, and a few selected stocks, I can run through all of these in about 10 minutes. That's how quickly, maybe less, maybe 5 minutes, I can go through them because I know what not to trade. So let me show you, for example, what not to trade. This goes back to our very first question. Is it trending or not trending? So we're on the daily time frame. Is gold trending? Yes, it is, but there's no trade set up yet. I need it to come back into the TradeStation. S&P, it's definitely overextended. Is it trending? Yes, it is, but it needs to come back into the TradeStation. So there's no trade yet. Okay, and I can just run through them. Euro dollar, it needs to come back to the TradeStation. So it's trending, but there's no trade at this time. Let's look at copper. Copper, interesting. It looks as though it's changing trend. So it wasn't a downtrend. It's actually testing an area now. So I'm a little bit cautious of that. We've got a downtrend on the weekly. We're at a key level. I might wait and see because it might want to change trend and go up. It might continue down. This could be a double top, a downtrend. So I might be cautious of that. What about platinum? Platinum is also looking a little bit too choppy, might also be looking to turn around. Let's look at cocoa. Oof, okay, there we go. All right, so cocoa. Now, this is a pattern that I recognize that might be new to you. This is a bullish breakout pattern. So believe it or not, it's testing this level, it's producing a series of high lows, it's looking more and more bullish, but we're on the daily. My expectation is at some point in the near future, somewhere between here and here, I expect this to break out. I said to you that every entry into a trade is either through a breakout or a pullback, but it could still stay here and then break out here, but somewhere there, that's my expectation. So there's no real trade on this just yet. Let's look at coffee. Coffee is very choppy and volatile. Let's have a look at gas oil. Okay, gas oil, what's going on here? So gas oil is quite bearish, trending lower. And so I'd be looking for selling opportunities here at this time, right now, for the moment. Let's have a look at a few others. So these are different commodities as well. Cocoa. We did look at cocoa. That was the bullish one. Did we look at sugar? No, we didn't. Sugar, very bearish at the moment. Okay, looking at the weekly, very bearish, coming down into these key lows here. Heavy, good for sales. Commodities are very much better traded rather than investing. So currencies and commodities are better, in my personal biased opinion, based on experience, better to trade than to invest in because they're seasonal and you can go through downtrends. So if you're buying a commodity, it can go down for years. And so you really want to be cautious about that kind of thing. Okay, so not really a lot going on with wheat, for example. Here it's largely volatile. That's on the daily. It's also trying to turn around. It's trying to turn around, but it's not tradable until it breaks above these highs. So there's nothing there. If you go to the 4-hour, it's just a nightmare. Okay, so there's nothing really going on that one. So as a reversal candidate, for example, on our list, on our watch list, yes, there could be something here. You can see how it couldn't break through this level. It's trying to do what we refer to as an inverse head and shoulders. So here's your left shoulder, here's your head, here's your right shoulder. So we could see a reversal. And if that is the case, it's going to travel about that same distance, which puts it up here. So there's a trade to be had from there to there, at least. And again, a trade is a single move, a single impulse, okay, from there to there. Cool. Then, so those are the kind of things we want to be paying attention to. We're actually doing pretty well. Let's go through and have a look at the indices because I want to talk to you about, we've determined we're in a bull market. So we already know we are definitely in a bull market. But let's have a look at a few of these. So let's look at the Dow. So again, when you find yourself, or if you find yourself a little bit confused, I don't know what's going on in the markets, the best advice that I can give you is to go up the time frame. So you look at the weekly to get clarity. So imagine that you're lost in a forest, but you have a drone with you. You could take the drone, have it go up, and obviously you look here on your monitor or on your goggles or on your phone. As it goes up, eventually it starts to clear the forest. You can see yourself getting smaller and smaller and smaller. Then maybe you see a river to the right. Maybe you're looking for a nearby town, a nearby village. Then maybe you see an open patch, and then you see the town. So the higher up you go, the more you gain perspective and clarity, and then you can get your bearings. Okay, so when you find that it's too choppy, you need to go up the time frame to get clarity. And you can see here that the weekly is trending up and nice and bullish. The NASDAQ as well, trending up, very nice reaction. We managed to maintain higher lows, so we still kept high lows. We are still in an uptrend. And certainly from a monthly perspective, we've got a very strong bullish candle. And you can see that pull back into the train station. So we had a bit of a correction there, back into the train station, and now on its way back up. And here it came back almost to the 50 and went away, almost to the, or past the 50 and went away. So we're very nice and bullish there. So these are worthwhile looking at. But my problem now is that we had a downtrend over here, which is fine. It was a temporary downtrend. Now we've gone up. We've broken this high over here. So we've broken that high. We need to have a pullback and then to carry on. So it's overextended. It's had a very big move up. We needed to retrace probably somewhere into this area, probably. It might be a shallow one, might pull in there. So we might see a pullback to here and it carries on going. or a pullback to here and carries on going. One of those two is likely into those price levels. Let's look. We've got the dollar index here, which is really good. So the dollar index will also give us a sense of what's happening with the dollar, the US dollar. Right now, the US dollar is bearish. It's important. I want you to notice, please, that we are sitting within a range. So the US dollar is sitting within a range. So it's roughly around about here. 100 is a big level psychologically as well. So we've got 100 and 101 as well. There we go. These are our levels where the dollar is. It's stuck within a range. It's currently weakening, but it is also close to a range. And so right now we have a weaker dollar. But if you zoom out and look at the overall history of it, the overall history of the dollar is that it is roughly in the same area. Actually, I've got more history. I can go all the way back to the 70s where the history goes back to, and the dollar is sitting in roughly the same place that it was in all the way back to the 70s. So you might be thinking, well, okay, so the dollar value of the dollar against all the other currencies is roughly at the same value that it has. It bobs around either above or below, but it's in the same value that it's been in since the 70s, since the currency markets kind of started. So you might be thinking, yeah, but I hear all these stories about how the dollar is going to be replaced as the world's global reserve currency, or BRICS countries or something. And a lot of that is nonsense. A lot of that is just sheer dramatic rabbit hole YouTube kind of nonsense. So first of all, for the following reasons. Yes, the value here has been roughly the same since the 70s, but yes, inflation has kicked in. It means that a dollar today does not buy you what a dollar could buy you in the 70s. But here's where most people make the mistake. It isn't just the dollar that's lost value. Every single currency on the planet in every single country has lost value since the 70s. Every single currency can buy you less today than it could buy you in the 70s. So every currency devaluates. That's just like everything in life gets old, ages, and dies, so to speak. Every currency devalues. That's a fact. So the US dollar devaluing actually doesn't mean anything. It's moot because every currency devalues. All right. So inflation is a part of life. People want to charge more so they can make more profits, which causes inflation. That's just how it goes. And so next point, is the US dollar going to be replaced as the world's global reserve currency? No, it's not. Not that I can tell, unless the US, which is the world's, basically, think about it like this. It's the world's largest GDP, okay? It's bigger than the next 8 countries combined. China's one is, and China's catching up. So China is a competitor, but it's still 65% of the US GDP. They will see how that goes over the next 10 years. China grows really rapidly as well, but they've also kind of shrunk. So you can't have unlimited growth. You do have contractions as well. At the end of World War II, the US possessed 95% of the world's wealth. Okay, the largest GDP at the moment. Their currency is used in 90% of all transactions on the planet, not just in the currency markets, but the bond markets, the stock markets, commodities are all priced in gold, are all priced in US dollars. So everything is priced in dollars. And it isn't just that, it's English. So let's just say, for example, that China was going to become the world's next global reserve currency. That means that China has to take on the rest of the world's debt. And right now, they're not in a position to take on all of the world's debt, because that's what the US is doing. It's carrying the world's debt. China has to take that over. So nobody really wants to be responsible for taking on the world's debt. Then everybody and all the countries that are tied into this have to learn another language, which means you all have to switch to Mandarin, which means all the paperwork, the legal paperwork, everything has to be changed to Mandarin. Now, if you live in the UK, you're familiar with Brexit. Brexit was just the UK leaving the EU, and that has still destroyed the country for about the last 10 years almost. It's just been so damaging, and there was just one country leaving the EU. Changing the world's reserve currency is monumental compared to that, okay? Nobody really wants to do it. Nobody wants to change their languages, and there isn't any reason to do it right now. So anyone who's telling you that it's imminent, it could only happen under the following circumstances. It can only happen if the US was no longer a democracy. So if there was a coup and and all the other countries, all the other G9 now had no faith that they could trust the US to be stable, then we might look at that. But that would have to happen, and it looks like that's not going to happen anytime soon. So I assume for now, the US is going to retain its democracy. And as long as, in my lifetime at least, in the next 20 to 50 years, I expect the US to remain the world's reserve currency as long as it's a democracy. And the economy is doing really well. Still the best economy in the world. Then people get concerned about debt. The debt, every country has debt. We have global debt as well. And there are plans to try to reduce the debt and try to stem it. So again, be very careful about YouTube channels that try to doom and gloom and get people to panic about all this stuff. This is not news, and a lot of the very brightest minds are working on that type of stuff as well. Okay, so just be aware of that. I just want to kind of provide some clarity where there's a lot of disinformation and misinformation. Okay. Okay, next, so we saw there's some good opportunities in those currencies. We've seen some of the markets are looking good. So for example, here's Facebook. Okay, this is Facebook on a monthly basis, looking nice and bullish, a little bit overextended. We go to the weekly. We've had a good correction over here. I would like to see a bit of a deeper correction at some point and maybe see the market come back down here, but that correction might only happen next year. Now, I want to bring up one more thing, which is September's. Historically, September's can be very bearish months. Historically, they tend to be very bearish months. Excuse me. So if we go look at this, we will see that last year, August to October was a monthly correction. We can see also there was a part of that over here. So August over here, August, September was over there. We also had a correction. I mean, obviously here was at the bottom. This is September. The bottom of the bear market at its lowest was September the previous year. So September's can be generally quite bearish. We're not there yet. It's a few weeks away. So my question is, will we maybe get a double top and another correction? Could that happen? It could. If it did happen, I don't want you to panic. It's just that we often have a correction, and then by October, November, we start to come out of it. Alternatively, we could have a correction maybe in the early part of next year. If we don't have it in September, we will have it, because we are starting to get a little bit overextended on a monthly basis. We have come down and correctly and touched the moving averages. We have done that, but I would like a little bit of a deeper correction, meaning a couple of red months, but we might not have that for a while. Okay, so not to create any panic, that would simply be a weekly, couple of months down on the weekly, or at least a couple of weeks going down. I want you to be aware of that. Okay, so we have covered a lot in this one, talking about different timeframes, strategies. We've looked at different markets. The bond markets, equity markets are looking nice and bullish. We didn't look at Bitcoin because I don't have it on my account for some reason, but I did talk about how it's very similar to the structure, and I used, I think it was Amazon as a similar structure to that, but they have the same kind of structures, and I expect them to move in tandem with those. We spoke about potential reversal candidates. I think bonds are now looking bullish, and I think they could be bullish for several years to come. That could be cool. Commodities as well. I spoke about gold being very bullish, but also overextended. And a lot of markets, we went through a lot of markets showing how the daily is due for a correction, which would be ideally this week and next week, and look for end of day setups on those. Risk management strategies, we spoke about doing a portfolio. We spoke about stop losses. We spoke about risk per position, the difference between investing and trading as a shorter term impulse. And then we spoke about the effect of news and economic data. So we just covered a lot of information in this webinar. I hope you found it instructive and useful. If you have any questions to do with your account or to do with the platform, please do not hesitate to get in touch with Vantage Markets using any of the contact details ahead of you on the screen now. And I'm going to stop streaming this, and I'm going to end the webinar, but I want to say thank you very much. It is always a pleasure, and I wish you the best in the coming week. Remember to keep calm and carry on trading. All right.